valuation problem on our spreadsheet here. We've got some data that I've already plugged in here, pretty straightforward. So we've got our EBIT, which is 450 million. Everything here is in millions. We have a 40% tax rate, so our NOPAT, net operating profit after tax, is simply after tax. So it's a formula of C5, which is the EBIT times 1 minus C6, which is the after-tax rate. So we pay 40% in taxes. That means we have to keep 60%. 60% times 450 is our 270. Time period T is the previous time, and time period T plus 1 is the more recent year. We've got our numbers in here for 36, 540, 540, and a total. So obviously know how to do a total. It's the sum of these three columns. This is the same these three rows. Same things for this column. Sum of these three rows, pretty straightforward. Same thing for accounts payable and accruals, and then the total here. We've got another total of these two rows in this column. And then, of course, our net operating working capital is the difference between the cash and of the positive cash and the accruals. What's left over is our net working capital. So you subtract C12 from C15. We get 576 in one column, 630 in the other. We have net fixed assets, which we just copied in. As you can see, this is just a number. There's no formula here. Copied in from the balance sheet. We have 900 this year, 750 last year. And of course, the total is the net working capital for this year plus the net fixed assets for this year. And then the other total would obviously be for the previous year. And so we get a free cash flow of $174 million. How do we get that? Well, we look at the 270 that is available, and then we look at the difference of keeping the operation going. Last year it took $1.38 billion to keep it going. This year it took $1.47 billion. So the difference, of course, came out of free cash flow. So we have free cash flow minus the difference in keeping the operation running is how much is available to shareholders. So that's what we start looking for, or what we end up with is 174, and then we start looking to discount or compound it forward and then discount it back. I also wrote the debt in here just so I could have it handy because I'm going to use that in the future. So it was 201 in notes and 450 in long-term bonds. Now we come here, and our 174 is at times 0. So we have times 0, times 1, 2, 3, and 4. So we have just time frames here. This is just a timeline. 174 this year. The 6% here, we're going to have 6% growth for the first year, the second year, the third year, and for the fourth year and forever on more is 3% growth. So I've set this up to do some simple calculations. The first one is the 174 from time 0 goes up at 6%, which is 184 in time 1. You can see that the formula there is quite straightforward. It is this year's C27 times 1 plus D25, D25 being the 6%, 1.06. So that's a pretty easy calculation. In fact, you can just drag it because the next number would be the same over if you wanted to. That would be another easy way to do it. So this is going to be the same calculation as 184 times 1.06 just to increase that. Now over here I've done something different. There's a reason why I want these in a line. So instead of 184, 180, 196, the next number here is down here. I put it down here, 207 in a lower cell. So this is simply the previous year's free cash flow increased by 6%. That's all this number is, this 207. I just put it down here for convenience, and you'll see why in a second. Now the constant growth model that we're going to use, the dividend growth model, the constant growth model going forward, here we need a D1 number. So the 207 is this year. D1 would be the next time period. In this case, the next time period we calculate, I've put up here at 213. How did I get 213? Well, I took this number of our current time period 3 free cash flow, and I multiplied it simply by 1.03 to get D1. So D1 is our constant growth free cash flow. And then to use the model, it's D1 divided by R minus G. So this calculation is simply D1, which is 213, R minus G. Well, R is our discount rate. We're going to use 5% here. Now, 5% was given as a discount rate. The 6% and 3% here were also given. They're not miraculously calculated from anywhere. I gave them to you as factors in the formula or in the problem. So these are givens. And so it's G27, 213, divided by 5% minus 3% or 2%. And so that calculation comes out to 10,673. And since this is in millions, the 10,673 would be read $10.6 billion. So the firm's cash flow from the end of year 3 forward is worth $10.673 billion. Now we need to discount all this back to find out what it's worth today. So what it's worth today is we have this 10 billion plus the 207 billion that it's worth up to time period 3. We combine these two and we end up with our combination of the future cash flow and the cash flow at time period 3. So we end up with a total of $10,880 million that the company is valued at, the cash flow is at time period 3. We also have time period 2 and time period 1 to deal with. So what we're going to do is discount this back and find a net present value for this cash flow. Now, net present value is easy to do. You can always just hit NPV and hit a parentheses, and it will give you the formula. So you can always find net present value formula. It's simple to do. Here, of course, I've got it for you. The net present value is the rate, which we use as this cell B28, or excuse me, B27. And then we have our windowed in cells D27 to F27. Guess why I put the 207 down here? Because it's so easy to window in if you get it out of the way. If it wasn't in there, it would have been harder to put the values in, and so I just made it easier for me to window it in for net present value calculation purposes. So that's all we need to do for net present value. So the cash flow has been discounted in constant growth mode to time period 3. Then time period 3 has been added to the constant growth mode, and all the cash flow has been discounted back to today at time period 0. So the firm is worth $9.75 billion right now today. However, we owe our bondholders, and I put these numbers in up earlier, and I just added them together to get the total amount of debt. So we owe our bondholders $651 million. We're going to pay them off to find out the value of just the equity, and if we subtract that, obviously this is just straight subtraction, C29 minus C30, we get $9.1 billion. We have 1 billion shares outstanding, so we have a $9.10 price per share value on this company. Now the price per share being $9.10 on this company means that if the price per share in the market were, say, $3, you would go, oh, I think it's worth 9. The market thinks it's worth 3. I might want to buy. Or if the market says it's worth 20 and you think it's worth 9, well, maybe you want to either sell or short the stock or get out of the stock or just not buy it. Whatever it is, it's negative. So that would be one way to look at it. Now, the other thing I've done here is create a chart so I can see where the market kind of feels the price or what the discount rate the market is using. So if the market was at $7 here, the market would be saying the discount rate or the risk of the stock would be equivalent to a 14% risk. If the market price was at $9.67 or even say $10, it would say it would be worth 3% or less, which is a very low interest or a very low discount rate, which means it's a very safe stock. So in this case, at $9.10 here with our discount rate of $5 or 5%, we can say it's a moderately safe stock at $9.10. As the price falls, obviously the stock becomes riskier. So the way to calculate this or way to set up this chart, obviously the 3, 4, and 5% is easy to do. You just type in 0.03 and below it's 0.04, and once these two are here, you just drag them because you've got a pattern now. Once you have a pattern, it'll just drag. That's easy to do. So we can clear that. Just grab that little X and drag it. This value is a little trickier because you need the dollar signs. I like the dollar signs. Everybody loves the dollar signs because they really help you. Dollar signs make things constant. So if I click on this value, we can see that we're doing the same net present value calculation, but I don't want anything to move except for the discount rate over here. So there's no dollar signs in the discount rate, but there's dollar signs on everything else. So I've got the discount rate for the NPV, and then I subtract out the debt, and that will give me the value minus the debt. In this case, it was 9,100, but in the rest of them, it'll be different. So you can see that there's no dollar signs here under the discount rate, but there are dollar signs on everything else, so it won't change. So that once you did that, you can just take that once you do it once and just drag it. So that'll work, and that's easy. And then the last thing is, of course, value per share, which is simply the value divided by the number of shares. So you've got no dollar signs on the C36, but you do have dollar signs on the C32 because you don't want it to change. So the 1,000 doesn't change, but every time I drag down, we go to the next value and we get a different answer. So that's how you get this table. Now, this table will tell you what the market's thinking. So when you look at, I think it's discounted at 5% is $9.10 is fair. If the actual price in the market is $7, the market is saying, if the cash flow is correct, the market is saying, wow, that stock is pretty risky because we're discounting it back at 14%. So this is a way to look at the way the market thinks about things. This is a way to look at the free cash flow of a company. And now you can see why when companies miss earnings, if I just change this 174, which is up here at 221, if I change that 174 and I change it to 100, what happens to the price? Well, the price all of a sudden changes to $4.95. So at 174 million in free cash flow, we're at 910. I drop that free cash flow down a little bit. It doesn't even have to be very much. Let's just take 10% off of it, or $17 off of 174. So times equals 174 times 0.9 equals 156, $8.13. So our stock price fell quite a bit when the free cash flow fell just 10%. So that's a way to look at how stocks are valued. So if you miss your number here, it transfers into all your future numbers, and that makes a big difference in your stock price. And you can also see that the market price would have been changing as well. So that's a way to do it. What I'm going to do is give you a problem, obviously, to do on your own. You saw all the equations in here, so you should be able to set this up pretty easily. And then I want you to tell me go or no go. Would you buy this stock or not? And if the market price was whatever I happen to tell you, would you buy this stock? Would you buy this stock? Would you sell the stock? Would you hold this stock? That's what I'm looking for you to be able to figure out. And of course, you just simply compare your valuation that you come up with to the stock price itself. If you have any questions, obviously I'm always available. Just put in the information, follow this video, and you shouldn't have too many problems. Thanks so much, and I'll see you in Cyberland.